So to get a look at how things are shaping up in this new financial year, Brett Mesurier joins us now from Shaw & Partners in Sydney. Brett, welcome back to Ausbiz. Thank you so much for joining us. If we can just stick with the big four banks, it all came down to earnings in terms of share price reactions, didn't it? Because despite Westpac and CBA paying out that dividend, those share prices fell on the day. So what does that tell us about the mood of investors toward the banks?
Well, they're still very sceptical about the banks, and that's really because loan growth is virtually non-existent. Margins remain under pressure, fee income continues to fall, and bad debts are problematic. We still have very large bad debt provisions which will probably need to be topped up during the course of next year. There'll be more, I expect there'll be more and quite significant bad debt charges to be incurred in the 2021 financial year. So the upgrades for banks are probably still some time away.
Brett, when it comes to dividends, what did you make of the split in the majors when it came to guiding for dividend payments?
Well, ANZ decided to pay an interim and Westpac did not. That was really because ANZ had a large gain from its trading activities in the Treasury and Markets business, including some customer income as well, whereas Westpac did not have the same sort of positive outcome from Treasury and the Markets business. Also, ANZ decided to hold its bad debt charge down. The increase in provisions was quite modest, whereas Westpac had a much greater increase in its provisions. Also, Westpac decided to increase its risk-weighted assets. So Westpac didn't give itself the capacity to pay a dividend, whereas ANZ did. ANZ obviously thought it was better to wait to the end of the financial year before it took into account the issues surrounding the ongoing deterioration in credit quality, whereas Westpac did not take such a wait-and-see approach. So ANZ could afford to pay a dividend and Westpac could not. I don't know the extent to which they decided to take that approach in the first place, and therefore the dividend was always on the cards for ANZ, or Westpac decided it was better not to pay an interim dividend and take a more wait-and-see approach. Meanwhile, it was building up its provisions and its capital position. So two different approaches taken by those two banks, and of course NAB had previously paid an interim dividend because it raised the capital, and Commonwealth Bank is in the strongest capital position of all. So it put out quite a decent dividend in the scheme of things of 98 cents.
So, Brett, I suppose it's fair to say, or is it fair to say, that the key tests are yet to come for the banks because, of course, we've had these deferrals, because we are still a little bit unclear as to the amount of bad and doubtful debts. And if that is the case, do you stay away from investing in the banks? Are there any areas that you would be interested in?
Yes, well, you're right to suggest that the key test is yet to come, because so far the losses remain very low. There's very little increase in losses at this stage, and that's because the effects of the lockdown are just starting to emerge. There are tens of billions of dollars in loan deferrals for each of the banks, and of course they're on home loans and small business loans. If you looked at ANZ and Westpac, just to carry on from those, they each had about $30 billion of home loan deferrals and another $10 billion of business loan deferrals. And the provisions are of the order of $5 to $6 billion, so you can see why those provisions may need to be increased, or probably will need to be increased in the 2021 financial year. But of course, when you look beyond that, you can see that as perhaps the vaccine comes, the lockdown restrictions are reduced, the bad debt charges fall, the bank share prices will ultimately rally. It's more a question of how long that's going to take, and unfortunately I don't think it's going to happen anytime soon, and that's why investors are still circumspect about what to do with the banks. In other words, they're not loading up just yet. But I like to think by the time we roll into next year, the bank share prices will start to move in a positive direction.
Brett, you mentioned a lot of uncertainty there about the outlook. That's not surprising. When it comes to looking forward though, what is the thing that you'll be paying closest attention to when it comes to future announcements from the bank that might go and guide your expectations moving forward?
Well, strangely, the things to look at for the banks, not specific to the banks, it's more towards what's happening with the spread of the virus and the way the governments react to that spread. In other words, the extent of the lockdowns. The quicker the lockdowns are released, the quicker the borders open, the quicker the recovery in the economy and therefore the lower level of bad debts. It's over to the government as to how they're going to tackle the virus. And so far they've been taking an approach which has depressed the economy, and what they've been doing is pumping money in to reduce the impact of that. But of course that is going to run its course, it has a limited time, and the pressure will be on early next year with the decisions that they'll have to make. Hopefully by that stage there'll be a vaccine out, at least in the northern hemisphere, if not the southern hemisphere, and that will make their decisions so much easier.
Yeah, well, here's hoping, right, Brett? Thank you so much for joining us today. We always appreciate your time.
Oh, you're very welcome.